Today, we're diving into a professional-grade strategy for swing trading gold. And look, this is one of the most interesting assets out there. By the time we're done, you are going to have a complete step-by-step plan for tapping into its powerful trends. So let's get right into it. So let me ask you a question. What if you could actually trade gold's big, powerful moves without having to stare at your charts all day long? Well, that's the whole idea behind the strategy we're breaking down today. It's all about efficiency and, precision. So just so we're all on the same page, what exactly is swing trading? It's not that crazy minute-by-minute pace of day trading. Not at all. It's about finding the main trend and then just capturing one significant swing inside of it. A move that usually plays out over a few days, maybe even a couple of weeks. All right, before you trade anything, you have to understand what makes it tick. And trust me on this, gold has a personality all its own. So let's take a minute and get to know our trading partner here. First thing you gotta know, gold is the classic safe haven. When things get shaky in the world, economic trouble, political instability, investors tend to drop the risky stuff and just flock to the safety of gold. This is a huge driver you always have to keep in the back of your mind. And on top of that, gold is also a legendary hedge against inflation. I mean, think about it. As the value of currencies like the US dollar goes down, gold tends to hold its value. It's a classic move for preserving wealth. Now, this one is absolutely crucial. Gold is priced in US dollars, right? So they usually move in opposite directions. When the dollar gets weaker, it just takes more of those dollars to buy 1 ounce of gold, so the price of gold goes up. So remember, a weak dollar often means a strong gold price, and vice versa. And of course, gold is sensitive to a whole bunch of other global stuff. You've got central bank interest rate decisions, big economic reports, and especially real bond yields. Why yields? Well, when the return you get from a super safe bond is really low, gold, which doesn't pay you anything to hold it, suddenly looks a heck of a lot more attractive. Okay, so we've got a handle on how gold behaves. Now, let's put together the specific tools we're going to need to analyze its chart. Think of it like getting your workbench all set up before you start building something. Now, we're going to keep our chart super clean, super focused. Just 3 main tools. First up, the 50 and 200 exponential moving averages. These are going to tell us the main trend. Are we in an uptrend or a downtrend? Simple. Second, the relative strength index, or RSI. This helps us see if the market's getting tired, if momentum is fading. And third, the Fibonacci retracement tool. This thing is like a roadmap that shows us the most probable spots where price might turn around. And here we go. This is the real core of the strategy. It's a disciplined 5-step checklist that you're going to use to find a high probability trade. This isn't about gut feelings or guesswork. It's a repeatable system. And listen, this checklist is sequential. You got to follow it in order, no skipping steps. We start big picture on the daily chart just to make sure we're trading with the main trend. Then we zoom into the 4-hour chart to find a nice, healthy pullback. After that, we look at our RSI to see if that pullback is running out of steam. Then we use our Fibonacci tool to pinpoint our potential entry zone. And only when all 4 of those things line up do we do the final step. Wait for a clear candlestick pattern to tell us, okay, it's go time. Now, this brings us to probably the most powerful idea in this whole strategy, confluence. We never, ever take a trade based on just one signal. The real magic, the A+ setup, happens when multiple things all line up in the same area. It's like your 50 EMA is providing support right at the same spot as a key Fibonacci level. When all your tools are pointing to the same spot, that's when you really pay attention. Finding a great entry is awesome, but it's only half the story. I'm serious. If you don't know how to manage your risk and exactly when to get out, you will never make money consistently. This part is every bit as important as finding the entry. So let's start with the most important number in your entire trading plan. The absolute minimum risk to reward ratio for any trade you take with this strategy is 1 to 2.5. That means for every single dollar you risk, your target needs to be at least $2.50. This is a hard rule. It's totally non-negotiable. So what does that look like on a chart? Well, our risk is small, it's defined. We put our stop loss just below the point where our idea is proven wrong. But our potential reward, it's way, way bigger than our risk. This powerful imbalance, this asymmetry, is the engine that drives long-term profit. It means you don't even have to be right all the time to make money. Okay, so let's walk through the exit plan step by step. Your initial stop loss. It goes right below the low of that 4-hour pullback. Easy. Your profit target, you're aiming for the last major high. Now here's the pro move. Once the trade moves in your favor by the same amount you risked, a one-to-one move, you immediately move your stop loss to your entry price. Boom. It's now a risk-free trade. From there, you can just let it run to your target or maybe even trail your stop to squeeze out a bit more profit. All right, finally, let's boil all this down to a simple set of golden rules. These are the non-negotiables. Think of them like the guardrails that are going to keep you safe and protect your account over the long run. These rules are your lifeline. First, never risk more than a tiny piece of your account on any one trade. Second, stay away from the madness of big news events like the Fed announcement. This strategy is not designed for that kind of volatility. Third, you got to be patient. These trades can take a few days to work out. And lastly, and this one is so important, always wait for that 4-hour candle to close before you make your move. Don't jump the gun. So what's realistic to expect from this? Well, here's a typical profile. Now look at that win rate, around 45%. That might freak you out a little. You might be thinking, wait, how do I make money if I'm wrong more than I'm right? Well, that's where that 2.5 to 1 reward to risk ratio comes in. Your winning trades are so much bigger than your losing trades that they more than make up for it. That gives you a positive expectancy, which is just a fancy way of saying you have a real mathematical edge. So we've gone through gold's personality, the tools, the checklist, the rules, everything. So what's the one big idea you need to walk away with? At the end of the day, it really comes down to this. This is not a magic formula. It's a professional framework. It's built on having technical skill and, just as important, having a real respect for the asset you're trading. True success comes from having the patience to wait for that perfect setup and then the discipline to execute your plan perfectly over and over again. And that kind of leaves us with one final thought. The principles we've talked about today, patience, discipline, really understanding what you're trading, they don't just work for gold. They work everywhere. So the real question is, what other market are you trading that could use a little more of your patience?